Welcome to today's explainer. We're going to take all that confusing, jargon-heavy IRS speak and translate it into a crystal clear, actionable roadmap for your financial future. Because honestly, whether you literally just landed your very first job out of college or you're actively counting down those final few years until retirement, we need to unpack exactly how to make this system work for you. We're going to break down the complex rules, the tax benefits, and the specific strategies you need to absolutely maximize your wealth.
Okay, let's dive right into this by asking a pretty huge question, because really, understanding the answer here is the absolute key to securing those golden years. What will likely be the largest retirement account you'll ever own? Well, for the vast majority of workers today, the answer isn't some old-school pension, it's not a taxable brokerage account, and it isn't even an individual retirement account, or IRA. It's the 401k. This one single financial vehicle will likely hold the absolute lion's share of your life savings. How you contribute to it, how you invest within it, and eventually how you pull money out of it, that's going to largely dictate the exact kind of retirement you actually get to enjoy. So here is our roadmap for today. 1. What is a 401k? 2. Traditional versus Roth plans. 3. Matching investing. 4. Contributing and maxing out. And 5. Accessing your funds.
All right, let's kick things off with section 1. What is a 401k? The setup. You know, what's kind of funny about the name 401k is that it isn't some complex, high-level financial acronym. It's literally just a piece of tax code trivia. The US government basically created a very specific section of the Internal Revenue Code, Section 401, Paragraph K, to outline the rules for this employer-sponsored plan. And because it is sponsored by your employer, it comes packaged with some incredibly unique tax advantages that are specifically designed to heavily incentivize you to save for your future self. The absolute beauty of this whole system is that it makes saving completely and utterly automatic, totally removing that very human temptation to spend the money before you can invest it. You just tell your employer what percentage of your income you want to save, right? And then, before that money even has a chance to hit your checking account, your employer diverts it straight into your 401k. Once it's sitting in there, you get to choose from a menu of investments, like mutual funds or index funds, and that money begins to compound, potentially growing completely tax-free over decades. It's really behavioral finance at its finest. You simply can't spend what you never actually see.
Moving right along to Section 2. Traditional versus Roth plans. The big debate.
So, almost immediately, you're hit with a major fork in the road. Do you want to pay the IRS now with a Roth, or pay the IRS later with a traditional plan? Let's break it down. With a traditional 401k, you use pre-tax dollars, which lowers your tax bill today. Say you make $100,000 and you contribute $10,000, while the IRS essentially pretends you only made $90,000 this year. Awesome, right? But here's the catch. When you retire and pull that money out, every single dollar is taxed as ordinary income. Now, a Roth 401k is the exact opposite. You get absolutely no upfront tax break. You pay taxes on all your income today, and then you put those after-tax dollars into the Roth account. But the massive, game-changing benefit, that money grows completely tax-free. When you finally withdraw it in retirement, you don't owe a single dime to the IRS. So really, it all boils down to a strategic bet on when you think your personal tax rate will be higher, right now or in your retirement years. Now for Section 3, Matching Investing, the build. Listen closely to this part, because if your company offers an employer match, you absolutely 100% need to take advantage of it. Why? Because it is quite literally free money seamlessly added to your total compensation. A lot of employers will match a portion of what you put in. A very, very common formula is a 50% match on your contributions up to 6% of your total salary. If you're contributing anything less than that 6%, you are literally leaving part of your own rightful paycheck sitting on the table. No way around it. Let's put some real tangible numbers to this so you can see the magic. Say you're earning $6,000 a month. By putting in just $360 of your own money, which is your 6%, your employer instantly bumps your monthly investment up by $180. That means $540 is going into your retirement account every single month, but you only actually felt a $360 reduction in your gross pay. Guys, that is an immediate 50% return on your investment before the stock market even does a single thing. It is arguably the most powerful wealth-building tool available to the everyday worker. Now, there is a tiny catch here, and it's known as vesting. While your own personal contributions are always 100% yours from day one, you might actually need to stick around at your job for a few years to keep all of that free matched money.
Employers use these vesting schedules as a sort of retention tool, basically a pair of golden handcuffs. If you leave the company before you're fully vested, you might end up forfeiting some or even all of the employer match. So always check your specific plan's vesting schedule. You want to know exactly when that free money permanently becomes yours.
That brings us to Section 4, contributing and maxing out, the peak.
So a question we get all the time, just how much should you actually be saving? Well, the reality is, the longer you wait to jump on this life cycle journey, the much higher percentage of your paycheck you're going to need to set aside to catch up. To hit your goals, a 10% to 15% total savings rate in your 20s, and yes, that does include your employer's match, is usually enough to secure a really comfortable retirement. But if you delay starting this until your early 40s, you've missed out on 2 full decades of compound interest. That means you suddenly have to funnel a massive 25% to 35% of your income into your 401k just to end up in the exact same place. Time is literally money here.
For those of you out there who want to absolutely supercharge your savings, it's really important to know the IRS limits, especially since they update them pretty frequently. Looking at the year 2026, the standard limit you can defer from your own paycheck is $24,500. But check out these catch-up opportunities for older workers. If you're 50 to 59 or 64 and older, you can actually put in up to $32,500. And there's this special brand new enhanced catch-up for those right on the brink of retirement, ages 60 to 63, which allows for a grand total of $35,750.
Okay, but get this, it gets even crazier. If you combine your maximum personal contributions, your employer's match, and any other profit sharing or employer contributions, you get this staggering number, $72,000. That is the absolute overall maximum limit an account can receive in a single year for 2026. Now sure, very few people actually hit this absolute ceiling, but it really shows you just how much tax advantage capacity the IRS gives you, assuming you have the means and the employer generosity to fill it up.
Because these limits are always shifting around, your 401k is absolutely not a set-it-and-forget-it tool. A flat dollar election that successfully maxed you out last year might actually leave precious tax advantage space on the table this year. Or think about it, if you get a raise, a fixed percentage might suddenly push you over a limit way faster than you realize. Open enrollment is essentially your annual wake-up call to log in, review your strategy, bump up your percentage if you got that raise, and just make sure you're still on track to hit your goals.
And finally, we arrive at Section 5, accessing your funds, the harvest. All right, before we get to the fun part about retirement, we have to talk about the serious dangers of early access. The IRS strongly wants you to leave this money alone until you actually retire. If you try to pull money out before you reach age 59 and a half, the IRS is going to drop a massive 10% penalty anvil right onto your savings. And remember, for a traditional 401k, that penalty is stacked on top of the ordinary income taxes you'll already owe. You can literally decimate your account balance doing this. There are a few very strict hardship exceptions, or maybe loan options depending on your specific plan, but generally speaking, you need to consider this money locked safely away. So let's map out exactly when the federal government finally lifts those penalties and subsequently when they eventually force you to start emptying the account. At age 55, there's a special little carve-out called the Rule of 55. If you lose or leave your job at 55 or older, you can actually take penalty-free distributions from that specific employer's plan. Then, at age 59 and a half, the gates fully open up. Standard, penalty-free withdrawals can begin for absolutely anyone. But notice the end of this timeline. At age 73, or 75 if you happen to be born in 1960 or later, the government introduces required minimum distributions, or RMDs. See, they gave you a tax break for decades, and now, well, the tax man comes knocking to collect. You are literally, legally forced to withdraw a certain amount every single year, whether you actually need the money to live on or not. Calculating this required minimum distribution is surprisingly simple, but it is highly specific. You take your 401k account balance on December 31st of the previous year, and you simply divide it by a distribution period number that the IRS assigns based on your specific age. Let's do a quick example. Say you're 75 years old, single, and you've got exactly $1 million sitting in your 401k. The IRS table assigns a 75-year-old a distribution period of 24.6. So you divide 1 million by 24.6, which means you would be legally required to withdraw over $40,600 that year. And yes, pay taxes on it. Well, there you have it. Now that we've unlocked the mechanics of the entire 401k life cycle, from those first automatic deductions to the sheer magic of the employer match, all the way to navigating those final forced retirement withdrawals, the very next move is completely in your hands. You've got the map. The structures are already built into the tax code to help you succeed. So I'll leave you with this. Knowing the timeline and knowing the massive, immediate value of capturing every single dollar of that employer match, how are you going to optimize your very next paycheck to secure your future self? Thanks so much for watching this explainer, and I'll catch you in the next one.